Swayam Prabha. Digital India. Educated India.
Welcome to another session of Basics or Fundamentals or Foundations of Accounting and Finance. As you know, we have been dealing with the cost accounting part, and today we will deal with what we call it as the next level. In the last few classes, we understood the difference between what do you call it as the fixed cost, the variable cost, the direct cost, the indirect cost, overheads, how these overheads are apportioned, are divided, etc., out there. But today we move to the next level where we'll talk about what do we call it as the break-even point. How do we look at the break-even point, and how do we look at what do you call it as little bit of decision making that we will sort of do using the cost accounting information. Right. So, if I am going to have a set of PPT slides as well as PowerPoint slides, and as well as I am going to have some bit of numbers which I am going to use Excel to sort of keep working on. So, if I have to sort of start with, let me start with what do we call it as, what is a break-even point out? Break-even point is that point where you make no loss or no profit, where your cost that is equal to your revenue, what you have out. Your cost is equal to your revenue. The amount you spend is exactly equal to the amount that you receive out there, and that is what you say break even, where you make no loss or no profit out there in that point. It can be both expressed in terms of dollar terms or rupee terms. It can also be expressed in number of units I need to sell. Supposing my selling price per unit is fixed out there, I need to know how many units I need to sell to break even, because I know what is going to be my cost of manufacturing each unit. I know what is the revenue I am going to get for each unit. So, I will know what is the number of units I need to sell for achieving what is called as a break even point out there. So, one important aspect out here when we talk about break even point is what we talk about is contribution analysis. Now, what is that contribution? Let us sort of spend some time in trying to understand what is that contribution. I am just going to use my whiteboard out here. I am just let me sort of use the whiteboard to talk to you about what do we mean by, what do you call it as contribution. That is, we all know that there is going to be a fixed cost out there. There is going to be a variable cost. Variable cost is the cost which is going to vary with number of units. It is going to vary with number of units you manufacture. So, let us say, now let us get to slightly numbers. Now, I am going to use some basic numbers. Now, I say my selling price per unit, my selling price per unit of a particular product, let us say, is 100 rupees. My next, I would say my, let us say my what do you call it as, I am just going to use the board. So, let us say my direct material, my direct labor, my direct expenditure in this particular, so all these put together, basically your variable cost amounts to about 70 rupees out here per unit. Your fixed cost, your fixed cost is for, it is not related to the number of units you manufacture. Your total fixed cost, my total fixed cost is, let us say, about 1 lakh out. No, this fixed cost is not going to change. I manufacture, let us say that is the next step. I say I am going to look at, let me say I manufacture, let us say 100 units. My total revenue will be 100 into 100 rupees per unit out there. My variable cost will be 100 units into 70 rupees per unit out. If I manufacture 1000 pieces, my total revenue in this particular case is going to be 1000 into 100 and my variable cost is going to be 1000 into 70 out there. My fixed cost here also is 1 lakh. My fixed cost even here is 1 lakh out there. My fixed cost does not change in either of the case out there. So what happens? At every stage, my number of units that I am manufacturing keeps on increasing, my revenue will keep on increasing, my variable cost will also keep on increasing in relation to the number of units I am manufacturing or I am selling out. So what happens? Every unit I manufacture is going to give me this what do you call it as, if I have to use the word, what do you call it as, my selling price minus my variable cost out there. My selling price is 100, my variable cost is 70, it is yielding me 30 rupees. This 30 rupees is what I use to cover my fixed cost. This 30 rupees is what I am going to use. See, every unit I am manufacturing, I am getting a revenue of 100, but I am spending also some money. What is the money I am spending? I am spending about 30 rupees out. So, every unit I manufacture and sell, it is giving me 30 rupees for covering my fixed cost. That is what, this is what we call it as contribution. This is what we call it as contribution. Okay. Contribution is nothing but every unit I am manufacturing and selling, how much is it contributing towards covering the fixed cost and yielding profit. Covering fixed cost and yielding, sir, why did you bring the word profit here? We will come to it in a minute. Now, in this particular case, what is the fixed cost? My fixed cost is about 1 lakh out. Every unit I manufacture and sell is contributing 30 rupees. How many 30 rupees I have to get in order to cover this total fixed cost of 1 lakh? How many 30 rupees I have to get? Because how many units I have to sell? Because each unit is giving me 30 rupees. How many number of units I have to sell so that I get that 1 lakh, my fixed cost gets covered out there. So that is what we call it as break even point out there, BP. So it says my fixed cost is 1 lakh, my contribution per unit is 30 rupees, 1 lakh by 30, can you just check Suhail? 1 lakh divided by 30, because 1 lakh is the total fixed cost I have to cover. And 30 rupees is the contribution that I am getting every unit. So that means how many units?
3,333.
8,000?
3,333.
3,333. So if I manufacture and sell 3,300 units, if I manufacture and sell 3,300 units out there, I will earn 1 lakh, and that is the break even point. That is the break even point is 3,333 units is basically what is called as the break even point, where I make no loss or no profit. You want to verify it, we will verify it, no problem. Let us say my revenue, my total revenue will be 100 into 3,333. Can you tell me what is the number, Suhail?
3,33,300.
3,33,300. My variable cost is what do you call it as 70 into 3,333.
2,33,310.
There is going to be a small difference, that is going to be because of decimal 3,333. So if I make it 3,334 out here because of decimal, I round it off out there, in this particular case it will increase by what do you call it as it will increase by $30 more.
3,33,400.
33,000?
3,33,400.
Yeah, sorry, 3,33,400. And this will be 3,33,334.
2,33,380.
380. 380. So what happens? My contribution is exactly 1 lakh and 1 lakh and 20. That is what I see here, 1 lakh and 20. So what happens? My fixed cost is 1 lakh. Of course, one can say you make a profit of 20, that is purely because of the rounding off here, what you see. That is all. So what are we looking at? We are looking at, this is why the break even point, if you have to use the formula, it is nothing but my fixed cost but divided by contribution per unit. Fixed cost divided by contribution per unit. So what am I looking at? I am saying that every unit I manufacture is giving me $30 of contribution. My fixed cost is 1 lakh. So what have I done? I have said how many units I need to manufacture to cover this. Now you see 3,334. Now supposing I say 3,335 units I manufacture, that extra unit is going to give me 30 rupees. What is that 30 rupees? Fixed cost is covered. So that 30 rupees what it is giving me is basically what is called as profit. That the contribution what it is giving me, that extra unit, that is the 335th unit what it is giving me is basically going to be my profit out there, as you can see in the previous case itself. My contribution is 3,333.33. So if I manufacture 3,333.33, my total revenue would be, you could multiply, then my variable cost I could multiply in that process, then my contribution would have been exactly 1 lakh. If a contribution is more than the fixed cost, when will it be more than the fixed cost? When you manufacture number of units more than the break even. When you manufacture the number of units, even in this particular case we have manufactured 0.66 units more than the break even, so it is yielding me 20 rupees profit. So if I manufacture 3,335 units out there, now what will be the profit? My profit will be 20 plus another 30 rupees that I am going to get by the 3,335th unit that is going to give me. What happens if I manufacture 3,336 units? If I manufacture 3,336 units, the profit of 0.66 unit is $20, 20 rupees. 3,335th unit is 30 rupees, what you can see, and then 3,336th unit will be another 30 rupees out. So what happens? Every additional unit you start manufacturing beyond the break even is going to give you, that contribution is going to turn out to be what you call it as profit in that particular case. So that is what we talk about contribution analysis out there. So we are looking at how much is every unit contributing towards covering the fixed cost and yielding what is called as a profit for you. So the same thing I have explained it in the form using what you call it as a slides out there. I basically tried to explain it in with the help of the slides out there. In this particular case I have basically done the same thing. What is contribution margin? Revenue minus variable cost per unit, selling price per unit minus variable cost, break even, fixed cost by contribution per margin per unit out there. All those things are there in the slide also. That is what we basically talk about. I have given you some examples out here. I have used the pen and paper, I use a whiteboard to build in examples, but I have also built in some examples out there. You are looking at pet food. Your variable cost is $3.65 per box. That means 3.65 is 1.35 in the form of material, 2.1 in the form of your direct labor, 0.2 in the form of other aspects. That is what it is. Your fixed cost is $850 a month. Your selling price is $6.25 per box. How many boxes you need to break even? You can calculate. It is, I want to calculate the contribution. What is contribution? 6.25 minus 3.65 is my contribution out there. 6.25 minus 3.65, that is 2.60 is your contribution per unit. What is my fixed cost? My fixed cost is $850 a month. So I need to look at 326.923 or 327 boxes. If I manufacture, I am breaking even there. To move on further, from here, if you look at this, I have expressed this in the form of units. You can also express it in the form of dollars out there. I can also express it in the form of dollars. I will say in dollars, if I have to look at, I have to look at contribution margin ratio. That's all. And what in the ratio, when I say, what they call it in cost account is PV ratio. That is a common word that is used in most of the textbooks. Profit volume ratio. What we say, we call it contribution margin ratio. What is it? That is nothing but fixed cost divided by your contribution margin ratio. Contribution margin ratio is nothing but your contribution per unit divided by the selling price. That is what will give you the PV ratio or contribution margin ratio. Let me go back to my whiteboard and let me try and explain this. In this particular case, if I say my PV or my contribution margin ratio, in this particular case, we saw that contribution, let me use a different color, a little more brighter. Contribution is $30. My selling price is $100. So what is my PV ratio? My PV ratio is 30 divided by 100 into 100, because I am going to express it in the form of a percentage. Obviously, it is 30%. So what am I trying to say that? In this particular contribution margin ratio or profit volume ratio out here, I am trying to say that if contribution margin, my contribution margin or profit to volume is basically what we call it as the 30% out here, and that means my cost is, in this particular case, is 70%. My contribution margin out there is 30% out there, which is used basically for covering what is called as a fixed cost and yielding what is called as profit out there. So what happens in this particular case? If we say it's that is this 30% is the margin you are going to sell. Supposing I say my sale value is 5 lakhs. In this particular case, my sale value is 5 lakhs. So I know 70% of this is basically cost, 30% of this, of this 5 lakhs is going to give me what the money to cover my fixed cost and profit out there. That's all. That is what we call it as PV or contribution margin ratio. Let me move to the next stage. I say that supposing you say my company is operating and I need a desired profit or required profit. My company wants a required profit of, let us say, 20,000 rupees. Now I need to know how many units I need to manufacture for earning this $20,000 profit or 20,000 rupees profit. And I know every unit is giving me 30 rupees contribution. My fixed cost is 1 lakh. I need to earn a profit of 20,000. So that means how many 30 rupees I have to get, how many each unit is giving me 30 rupees, how many pieces of 30 rupees I have to get, so that I can cover the fixed cost of 1 lakh and earn a profit of 20,000. Very simple. My fixed cost, that is 1 lakh plus desired profit plus 20,000. That number of 30 rupees I have to get, number of 30 rupees is what I have to get. That is contribution per unit. 1,20,000 divided by 30. Can you tell me, Swayam? 4,000? 4,000, exactly.
Yes.
Yeah. So 4,000 units I manufacture and sell, I will get the profit of 20,000. You want to verify? You can verify. 4,000 into 100, 4 lakhs. 4,000 into, that is my total revenue. Total revenue or minus variable cost. What you can even look at what is going to be your contribution out there. Total contribution. My contribution per unit is 30. My total contribution is going to be 30 into 4,000. 4 into 3, 12. 1,20,000. My fixed cost 1 lakh. My profit 20,000. That's it. So, that is what we call it as the desired profit. I will go back to my presentations out here in this particular case. That is what we are going to look at the next stage out there. There is a cost volume profit graph out there. That is what I talked about. Now, before I move on to the what do you call it as the desired profit, I am going to spend some time on this profit volume analysis. I am going to spend some time on the profit volume graph out there. If I look at in this particular case of profit volume graph out there, I mean slight error in this because fixed cost is mentioned as 750, it is 850, that is all what you can look at. You will say that there is a fixed cost, that green line if you see here it denotes what is called as a fixed cost, there is a fixed cost. And the variable cost keeps on increasing with the x-axis is the sales in the number of units I have. So, what happens? Y-axis is the dollars, that is sales in number of units into the what do you call it as the price per unit, that is what gives me what is called as the y-axis out. So, what happens? Minimum cost you incur, this is flat, straight, fixed cost. The red line here indicates what we call it as the total cost, the fixed cost plus variable cost. 0 units you manufacture, you have only fixed cost. Additional units you manufacture, 60 units you manufacture, my total cost is 850 plus the variable cost of 60 units. So, it goes on increasing, that is what we call it as the total cost C. Then next is the P, profit line out there. So, that is the revenue what you are going to get, As you keep on increasing, the number of value of the total revenue will keep on increasing. There is a point at which these two meet, that is what we call it as a break even point out there. I am not going to spend much time on this. The next aspect what we talk about is margin of safety. If it is a growing, if it is an ongoing firm, the firm is already working on something, if it is an ongoing firm out there, then I want to know what is the margin of safety out there. Margin of safety means what is my sales that I am doing currently which is above the break even, that is what we call it as margin of safety. It is also explained with the help of a graph out there. Supposing you say the blue part what you see here is the break even point, this is the break even point out there, any sales below that point is all what is called as below the break even. So, any sales above the break even, what is it, that is all what is going to give you what is called as profit out there. So, what is the percentage of sales, what is the volume of sale, either in terms of percentage, in terms of dollar amount, in terms of units, it can be expressed in any of these terms out there. What is the amount of sales that is above the break even point? If it is a number of units, yes, it is a number of units. If it is in dollar terms or rupee terms, yes, in dollar terms or rupee terms out there. If it is in percentage terms, yes, it can be in percentage terms. That is what we call it as margin of safety out there. So, break even with the target profit, I just talked to you with the break even with the target profit out there. So, given this, I am going to move to what do you call it as the break even. There are you can look at break evens even when there are multiple products out there. We are not looking at multiple products out there. Sometimes what happens, you might have a target profit, but there are taxes the organization will have. In the 20,000 example what I said, I did not even consider the taxes as part of it. There can be taxes. So, if what you call it is the break in this particular case, you need to pay taxes on the what do you call it is on the kind of profit that you are trying to make out there. So, what do? We say total fixed cost plus target profit divided by 1 minus tax rate, that is what we will take to buy the contribution margin out here. So, what happens? The break even does not include taxes, the taxes can also be paid. The sales needed will have to be even higher to earn a profit of 20. Supposing it says in the earlier case what we said, let me go back to this. In this particular case I said $20,000. Imagine on this 20,000 you have to pay 30% tax. Then what is your net gain? 20,000 minus 30%, that is 6,000 rupees gone, you will get only 14,000. Whereas what was your target profit? Your target profit was 20,000. So, what happens? So, in that particular case, I have to earn a little more. Do I have to earn only 6,000 more? Do I have to earn only 6,000 more, 26,000? No. If it is 26,000 more, then what happens? It is 30% or 26. If it is 30% or 26, then your net gain what you will have will again be less than 20,000. So, what happens? It is 30% of the profit. So, what do we do in this particular case? As you would see in this particular slide out here, we say that target profit, I divided by 1 minus tax rate. That is what I have to look at. That 1 minus tax rate, that what amount I am going to get ultimately is what I, in this particular case 30% tax rate means 70% is what I am going to get. So, target profit divided by what do you call it as 1 minus tax rate out there, and that is what I will keep as the target profit out there. Moving beyond, I move to something called as operating leverage in this particular case. That is something like a sensitivity part of it. It refers to how many fixed and variable costs are there in a firm's cost structure. Operating leverage is as what you call it as a multiplier effect or a magnifying effect. Let us take an example. I will take an example and then explain. We call it, we use what is called as the degree of operating leverage as a measurement. Now, in this particular case, for degree of the operating leverage, we say contribution margin by operating income as a measurement of degree of operating leverage. Now, what does the DOL tell me, the operating leverage? It tells me what is the percentage of what do you call it as increase or decrease in sales that I will have on the operating income. What is the percentage of increase or decrease? Let's take an example, you will understand it better. I have got a small piece of example out here. Let us say I have taken picked up an example from one of the textbooks out here. It says that the company sells small bottles of water at $6 each. Variable cost is $2. My fixed cost is 30,000. Monthly sales is 10,000 units out there. My sales will increase by 10% next month, and so on and so forth. Now, in this particular, the question is, how will it impact the bottom line or the operating income when the sales increase? That is what your boss asks you. Now, what will you do? One way of doing it is, oh, my selling 10,000 units, now I will make it 11,000 units, then I will recalculate all the cost. Yes, that can be done, but instead I can just do what is called as the operating leverage. Currently, what is my contribution? $4. What is my operating income currently? Currently, if I look at my fixed cost as 30, my monthly sales is 10,000 units into what is called as in this particular case. So, in this case, that the total fixed cost is 30,000. What is my sale value? My sale value is 10,000 into $6, 60,000. What is my variable cost? $2 into 20,000. So, 20,000 rupees gone. So, net is basically 40,000 is what is my contribution. Fixed cost is 30,000. So, contribution minus my fixed cost is what gives me operating income, and that is what you see here. So, my degree of operating leverage is about 4 out here, that is my contribution margin divided by what is in this particular case by my operating income. Its degree of operating leverage is 4. Sir, how is it going to be useful? Just wait, then move to the next slide out there. Now, I will say results of August. You are selling 10,000 units, your operating income is 10,000, you got it, beautiful. Now, let us move to the what is called July. Now, let us go to the next one, the July, August out there. My increase in sale is 10%. So, what happens? My sale is 11,000. What happens out there? Variable cost, my contribution is 44,000 obviously, my fixed cost is 10. So, what happens? Your operating income has become from 10,000 it has moved to 14,000 out there. That is, there is a increase of about 40% increase in your operating, what do you call it as operating leverage, in your operating income. Now, what is that? Instead of doing this, I could have just said 4 is the operating leverage, 10% is my increase in sales. So, 10% into 4, 40% is going to be my bottom line increase or my operating income increase. If it can say, I can say 20% out there. So, then what will be it be? My bottom line increase will be 20% into 4. 80% is going to be my operating income out there, that is going to increase. Sir, how will it be 80? How will it be 80%? Supposing you say in this case $6, he says 20% increase in sales, that means 12,000 is the sales going to be. 12,000 is the sales going to be, 12,000 into 6. You can actually work out that way and then calculate what is the operating income in this particular case. So, degree of operating leverage means it is nothing that 4, a 10% increase in sales lead to 40% increase in what do you call it as a operating income out there. So, it basically, if I have to go back in this particular case out here, my degree of operating leverage is just the multiplier impact, multiplier that impacts the operating income to a percentage change in the sales out there. It's just a multiplier here by which your what do you call it as operating income is going to be impacted because of a change in sales out there, percentage change in sales out there, and that is what we saw with this example.